Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Dennis Dick. And we have the editor-in-chief of the Stock Traders Almanac, Jeffrey Hirsch. Jeffrey, how you doing this morning?
Great. Good morning. Happy New Year, guys.
We're doing good. Happy New Year to you. So let's just get you started here. I mean, who's your almanac really geared toward? Is it toward the passive long-term investor that just is look at the whole year perspective, or maybe active day traders? Who does your book appeal to the most?
I mean, humbly, it appeals to a broad swath of people, from traders to long-term investors who just want to look at things, people who just like to check on the long-term cycles. But I find professionals and individuals use it alike across the board. So it's kind of interesting. It's kind of flattering, actually.
So I actually did get a copy of it this year there, and I'm just looking here in January. So just tell our listeners here how this first week of January can sometimes predict the overall market for the year.
Well, even before the first week of January, I think you're referring to the first 5 trading days of
Yes.
January, the first 5 days early warning system. There's this thing we call the Santa Claus rally, which a lot of people get wrong, that they think is the whole year-end rally, which this year, December wasn't so great either. But the Santa Claus rally is the last 5 days of the year and the first 2 of the new year, 7-day trading period. And right now we're down on the S&P, and the years where the S&P has been down in the Santa Claus rally period, which is usually up about 1.5%, we've seen flat or really bad years. The last 4 times that happened was 08, 2000, 04, and 94. So a couple of flat years, with 05 there and 94, and a couple of real nasty years in 2000, 2008. So the other thing is, with the first 5 days, generally better in pre-election years. There's bullish bias there in and of itself, but also the January barometer, the full month barometer, which was wrong last year. I guess that's the 8th era since 1950. All the eras have been in secular years. But what we're finding
What's
is
the
that,
full month barometer, just to stop you there?
well, the January barometer, as January goes, so goes the year.
Okay.
We've seen, the market follow the course of the S&P 500 in January. About 77% of the time. If we take out the flat years, which is like where it was plus or minus 5%, it's more like a 90% accuracy ratio. So, it's been something. We have, new Congress is convening. We have State of the Union addresses. We've got people like ourselves making forecasts and predictions. You've got everyone sort of setting the stage for the year to come. And if the market likes what it sees, it's usually a good sign for the year to come. And if it doesn't, it's a warning sign, an indication to be more cautious. And what we see, we've called it the January trifecta recently, which is you have the January barometer, the first 5 days, and the Santa Claus rally, all in agreement up. It's a great, record. When they don't all agree, when they're all down, it's been, the years have been much less beneficial to investors.
So are you get a little bit cautious now here? I mean, because for us to get back to the levels from when this 5-day period started, we're quite a bit away from that. Do you make any kind of necessary adjustments? Will you make any kind of necessary adjustments to your trading in your portfolio once this time period concludes?
Yeah, at the end of today, we'll have the first sort of shot across the bow from the seasonal indicators, and we'll start thinking a little bit differently if we don't get it back there, if we don't have a big day, and then the first 5 days, and by the end of the month, when all 3 have registered, we will change course officially if needed. But right now, we've been in the market in portfolios and positions since the dip in late September, early October there. So we're pretty happy with that. Cautious watching some of the gains get pulled back a little bit. I don't like to sell winners. We have, traded a few things, but we're starting to get concerned with this Santa Claus rally on the negative side so far. We got another day of that though. Today.
What about years ending in 5? Is there any truth that years ending in 5 are supposed to be a good year? You have any historical data on that?
Yeah, that historical data goes back to 1880s, and that's the proof is there. I mean, I don't think the decennial cycle is as powerful as some of the other cycles that have a little bit more drive behind them, like the 4-year presidential election cycle. But one of the things that has been most consistent has been the 5th year. There was only one loss in '05. Otherwise, it's been it was a 12-0 record up to that. So 5th year of decades is pretty strong. The pre-election year, which is what we're here now. The one caveat with pre-election years, which is the best year of the 4-year cycle, there hasn't been a losing pre-election year since 1939 for the Dow. The S&P was off a fraction in 2011. But this is the second term, the second pre-election year, and those have not been as strong as other years. 87 was one of those that took a chunk out of that record. So, there's some confluence of indications of cycles here. On paper, it adds up pretty well. Looking, when we were looking at it a few months ago, and even when we put the Almanac together back in May, June. But right now, with the Fed, looking ready to start inching things up, and some of the overseas stuff is positive, where we have, the quantitative easing over there looking like it will end up in the U.S. market. But, we've come a long way. Everyone's talking about long in the tooth. My forecast is out there. I'm looking for about down 19,000 in the first half, and then flat to sideways, maybe a little bit higher in year end. And I think we're beginning to see the beginning of the end of this bull market.
Jeff, what sectors here at the beginning of the year are typically stronger? Like, just go through the seasonality a little bit there.
Well, almost all sectors are in bull seasons right now. Biotech is one of the bigger ones. From October through March, April, May is sector seasonality season. One of the ones that we just sort of bailed on was the oil stock, seasonality. The XLE, the spider there that trades the stocks that are in oil. We just that's a December to sort of July seasonality for the oil producing companies, and we just cut bait. We were up a couple percent in that. We don't like what oil looks like on a more macro fundamental picture as we're all seeing out there. It looks like it's going to go to 40, and that's not great for those companies. But on the bullish side, biotech, tech, consumer stuff, a lot of those sectors are up quite a bit. So, and the other thing I'd caution people about, we've been seeing profit taking in January. There's the old January break that they talk about in the futures pits out in Chicago, and that seems to have been coming home to roost a bit more. January has not been as strong as it's been, and the market's pretty extended.
Okay.
So I wouldn't be surprised for a bit of a January break here.
Okay, Jeffrey Hirsch, editor-in-chief of the Stocks Traders Almanac, joining us here. Jeffrey, thanks a lot for a little bit of insight into the Almanac, and we are definitely going to be taking notes of your predictions today and hope to have you on again soon.
My pleasure. Anytime, guys. Take it easy.